Let's start with that, Greg. Your reaction to the idea that this social media company is trying to market 8% of the offering to Redditors who don't seem to like the company offering them.
Well, thank you for having me, Ed, and good to see you again. You know, it's smart. Clearly, there's a risk that Reddit sees with, just being a commercial enterprise at all, and now, selling themselves, as a public company and, trying to maximize for profits. It's kind of violates, the relationship that they have with their users who contribute a vast amount of content for free. And now they're potentially, the commercialization becomes a risk factor. And so how do they mitigate that risk? They make their users and their content generators part of the company. They give them an economic incentive to say, positive things about Reddit because, now they're hopefully going to be IPO share owners and they're going to be motivated to, speak well of Reddit. So I think it's smart in what they're doing, but there's still a risk that the Reddit backlash, from people who don't own shares or people who, shirk the opportunity to own shares because they want to remain on this, bohemian community. There's still that risk, but I think it's smart what Reddit is doing.
I've been reflecting in the last 24, 48 hours on the timing of all of this. I remember back in 2021 when they confidentially filed. 2021 was like the banner year for the US IPO market. And I just wonder how you frame the timing of whether they missed the boat or actually they were right to wait until this point.
Yeah, well, I mean, listen, it would have been great if they could have gone out, maybe in 2019, 2020, and had a few years of the zero interest rate environment that we had, and sort of shored things up, shored up their aftermarket performance. But I think going public at the end of 21 would have been a big mistake. Obviously, 2022 was a significant down year. I think their valuation would have been hammered. They would have lost, all of the halo effect of being a new public company. They were clearly, way behind in terms of revenues at that point. They didn't have an AI story like they're trying to really tell now to beef up their valuation. So I think it's a good thing that they didn't go public then. I think the markets are more favorable now for more of a long-term, successful story. And I think they're going to price their IPO at a much more reasonable valuation now than they would have in 2021.
I want to talk about the valuation, but I also do want to talk about AI. You said that they're now telling the story. That story is essentially what we could do is license the content to those who want the data to train large language models or foundation models. How does that sell to somebody deciding whether or not to buy into an IPO?
Well, that's the million-dollar question. There's no doubt that the company today is 98% advertising revenue. So it's a media company, and it should trade more like a Pinterest or a Snapchat. But they are trying to push the narrative to sell more like an AI data company. They do have a lot of proprietary data that's this user-generated content around various interest groups, whether it's stocks or cars or all kinds of interest groups, so that they do have a lot of content that their users are generating, and it's proprietary. And so they've done deals already with Google. They've talked about 200 million of sort of this data revenue over the next 3 years, including this around a $60 million deal with Google. So they do have actual revenue associated with this AI training model. The AI coming onto their site, crawling through their data and training itself. So there is a story there, but it also, again, it runs the risk of inflaming their users who are like, hey, you're selling my data, you're having an AI train on me, and I'm not getting paid for it. So there's risk to that strategy as well, but I think they're trying to get away from just being a pure advertising revenue narrative, and I think it's a good strategy if they want to lift their valuation.
Okay, so valuation at the upper end of the range, $34 a share on a diluted basis, taking into account RSUs and whatnot, $6.4 billion. How marketable is that? People pay a lot of attention to a headline figure on valuation.
Yeah, well, the company did about 800 million of revenue last year, grew about 20%. So, kind of pedestrian growth. 98% of that revenue was advertising. If you just were to apply a 5 to 7x multiple to that, which is where their comps, Pinterest and Snapchat would, sort of trade in that range, you'd come up with a 4 to $6 billion valuation. So 6 at the very high end, and frankly, it probably should be closer to 5. We're seeing trades on our platform at the 4.8 to 5 billion range in the private markets before they hit the road this week. So I think that it's a stretch, and again, I think it's a question of whether the market will buy into this emerging data AI story that they're trying to tell. They do have some contracts, they do have some revenue, and in order to push clear of a traditional social media multiple, that's what the market's going to have to believe, and that's why they speak up of Sam Altman with his investment and him being involved with the company, and there's a lot around the AI story in order to push that multiple up, but I think it's going to be a challenge.